Good morning and welcome to Charting the Markets on Tuesday, the 28th of February. Let's begin by having a look at today's economic calendar, because at 1:30 p.m. we've got Canadian GDP out for the fourth quarter of 2022, and we expect the Canadian economy to have grown by 0.4%, and that compares to a rise of 0.7% in the third quarter. Then this is followed at 2:45 p.m. by US Chicago PMI data for February, and we expect this to rise to 46. And at 3 p.m. we've got US consumer confidence out for February, and we expect the index to rise to 109.50 from 107.10. Now let's begin by having a look at the FTSE 100, and as we can see here, the FTSE 100 struggled as of last week and is currently testing its 2023 uptrend line, that is to say the January to February uptrend line, as we can see here. And we'll have to see whether we can hold there or whether we are likely to fall through Friday's low from last week at 7,870. And the reason this is important is that this is the last reaction low on this daily financial bet, meaning that the low last Friday was made lower than the one on Thursday and lower than Monday of this week's lowest point. And if we fall through a last reaction low, then normally we would head to the next one, which would be the 10th of February low at 7,850. So basically, if we fall through 7,870 and 7,850, to me, it would say that we then are likely to decline further and to fall to the late January low at 7,708. Because as you can see here, the latest high, the all-time record high we made above the 8,000 mark in mid-February has been accompanied by negative divergence on the relative strength index, basically the oscillator here at the bottom, not confirming the new all-time highs. And that quite often then leads to at least a sideways consolidation phase, which is what we've seen, to be honest, over the last 1.5 weeks or so. But it could also turn into a top formation. And for this to be the case, as I say, we would have to fall through 7,850, which would then take us back down again to 7,708. But if we were in the weeks ahead to fall through 7,708, then a major top in a medium-term downtrend would have been formed, meaning that last year's decline would likely then continue. But that's a long way off. Let's see what happens short term. Short term, we're testing this support, and yes, short terms, the FTSE 100 does indeed look toppish, as does the German DAX 40 contract. As you can see here, it has actually held extremely well. It has been extremely resilient of late. When the US market sold off, basically a lot of money flowed into European markets and mainly the DAX, which is why the DAX 40 has held much better than other European markets over the last few weeks. And as you can see here, we've just basically traded sideways. Having said all that, we haven't managed to rise above the early February high at 15,656 on this daily financial bet. And instead, last Friday, in line with US markets, have fallen through this support area I've been mentioning for the last few weeks, made up between the early to mid-February lows between 15,272 and 245. We dipped down to 15,185, but then on Monday had a big relief rally take us all the way back again. And today, this relief rally is now giving way to some short-term downside being seen again. So right now, as you can see here on this daily chart, we are basically trading sideways in this triangular formation, but the breakout points we need to watch out for with regards to the medium-term trend are basically to the upside, this whole area between 15,556 and 15,656, so the highs we've seen during February, and on the downside, Friday's low. And Friday, of course, if you remember, we came off with regards to US markets and then Asian and also European markets, because the PCE price index, the favored index with regards to inflation watched by the US Fed, came in stronger than expected, and that pushed equity markets lower as they anticipate the Fed to hike rates further and keep them at elevated levels for longer than was previously anticipated. And this basically had a negative effect on the equity indices globally. And if we were to fall through this low we saw on Friday of last week at 15,185, that would then take us probably through this uptrend line, which can be drawn in from the December lows of last year on the DAX 40 contract, and that comes in around 15,130. Any fall through there would then take us back to this key support area between the mid to late January lows, and these come in between 14,992 and 904. And that is really the crunch level with regards to the medium-term uptrend, because if we were to fall through there and close through that level, 14,904 on this daily financial bed on a weekly closing basis, that to me would mean that another top has been formed and that we could easily slide back towards the 14,000 area. So right now we're just holding quite well, trading sideways, but that could change if we were to fall through the uptrend here at 15,130 on the DAX 40. Now, why am I saying all of that? Because basically, if you look at US markets such as the S&P 500, they have been leading the downside recently. And as you can see here, the S&P 500 has fallen through its December to February uptrend line, as you can see here, and did dip down to the red line here, the 200-day simple moving average, which comes in at 3,940, which has held so far. But what I also mentioned last week when we did charting the markets is that we have this long-term downtrend line in place going all the way back up towards the 2022 January highs. You can see this long-term downtrend line, which was breached at the beginning of January, at the end of January and beginning of February of this year, but then acted as support. So basically, a previous downtrend, when it gets breached, can, because of inverse polarity, act as support when that gets retested in the future. And this is what happened last week. As you can see here, we held around that breached downtrend line. But this week, we had our relief rally here on Monday, as you can see, but then it petered out again and we closed below that breached long-term downtrend, which is now our resistance line. And today we're testing it to the upside. And together with the breached December to January uptrend line, that also caps the upside short term. So what I'm basically saying is that the odds seem to be stacked towards further downside to be seen, provided we stay not just above Monday's high, which was just a bounce back from last week's decline, but also ideally last Thursday's high at 4,026. So for me, from a technical perspective, short term, as long as we stay below 4,026, the odds are pretty high that we will retest the 200-day simple moving average 3,940, and that, if that were to be fallen through, would then take us back down again towards the December lows at 3,746. So for me, it's likely that we will see further downside with regards to equity markets in the days and weeks ahead. Now, US equity markets have come off on the back of a rising US dollar. And the correlation between the inverse, so negative correlation between US stock markets and the US dollar is at very elevated levels and trading at levels close to all-time record levels seen quite a few years ago. So basically, every time the US dollar continues to appreciate, US equity markets seem to be coming off. And the US dollar is appreciating at the moment because of this strong data we've seen out of US markets recently. For example, the strong PCE price inflation reading we saw last week, which came in stronger than expected. And that then pushed the US dollar higher and US equity markets lower. But if you look at the US dollar basket, what has also happened from a technical perspective is that we have formed this bullish bottoming formation. So we've now broken out and above this resistance area I have been mentioning for the last few weeks, between 103.08 and 103.63, basically made up of the mid-December lows and the early February high. And we now trade above there. So any short-term retracement lower that we may see in the next few days would probably take us back down towards 103.63 to 08, but that support area is then likely to hold. And for me, technically speaking, as long as we stay above the last important relative low here, which was made in mid-February at 102.18, the recent uptrend is likely to continue to take us towards the early January high at 105.37, and also the red line here, the 200-day simple moving average at 106.20. So I would buy into any short-term dip with regards to the US dollar basket based on this bottoming formation, based on technical analysis. Now, as we know, the euro dollar makes up 57.6% of the US dollar basket and is basically the inverse. And what we're seeing here on this daily financial bet on euro dollar is that we have broken out of a short-term February downtrend here. And we started doing so yesterday. And we may short-term see a little bit further upside with regards to this currency pair. But there's quite a lot of resistance, as you can see here, around the 106.55 to 106.70 area to be seen. So I wouldn't be surprised if we peter out there and then resume our descent. Basically, technically speaking, for me, as long as we stay below this resistance area, which was the previous support area for euro dollar between 107.36, the mid-December high, and 108.04, the mid-February high, as long as we stay below there, basically, we are in a downtrend now. And that could take us back down again towards the 104.84 to 104.44 area, which is made up of the late and mid-November highs, the early December lows, and also the early January lows. So basically, for me, further downside is likely to be seen on the back of this hawkish Fed. And don't forget, we are pricing in Fed fund rates to have a terminal rate now around the 5.4% mark, which is much higher than it was just a few weeks ago. So I wouldn't be surprised if we see further upside with regards to the US dollar. But moving on to European markets, and especially euro sterling, what is interesting here is that we are currently retesting last week's low, which was made at 87.84. And this is on the back of a stronger British pound, as the British Prime Minister Rishi Sunak yesterday met with the European Commission President Ursula von der Leyen and basically hammered out a post-Brexit deal to do with the Northern Ireland Protocol. And this is all pretty positive for the British pound and could mean that with regards to euro sterling, we could see some further downside, take us down to the late January low at 87.63, and then probably also towards the January low at 87.22. And as you can see here also, we are now breaking through this December to February uptrend line, having actually already broken another one just a few days ago. So for me, further downside is likely to be seen with regards to euro sterling. And I mentioned a stronger British pound, and as you can see here on the daily financial bet of cable, that is to say the British pound against the US dollar, we have once again bounced off the red line here, which is the 200-day simple moving average at 119.27, and then formed this bullish candle here with some follow through today on the back of this agreement between the European Union and the United Kingdom with regards to the post-Brexit trade agreements. And this can now take sterling with regards to the US dollar back to this 1 month downtrend line, which currently can be seen at 121.06. So that would be the next upside target for today, followed by the 21st of February high at 121.47. Now, this would need to be taken out for us to form a reversal pattern here. So I know that we've tested 3 times the 200-day simple moving average and seem to have bounced off it every single time in the last month or so. But we really need to take out the last reaction high here, which is the 21st of February high at 121.47, for us to then see further upside, perhaps take us back up towards 122.70. So that might be difficult with regards to the US dollar, because that I also expect to continue to strengthen. So we'll have to see what happens there. But short term, definitely, it looks as if we are reversing with regards to cable. Commodity markets have also been impacted by the stronger US dollar, and we've seen the price of WTI and oil in general come off over the last few weeks, and that was basically on the back of surging US stockpiles and the prospect of further monetary tightening, taking the price of oil downwards. And basically what we can see here is that we did bounce over the last few days from last week's high at $73.85 on the back of still demand optimism seen with regards to China, as oil imports in the world's largest oil importer, China, are likely to hit record highs in 2023 amid rising demand, and also oil being used for transportation fuel and for new refineries, which are expected to come online this year. And the oil price has also been buoyed slightly today on the announcement by Russia that it plans to cut oil exports from its western ports by about 25% in March. And this exceeds its announced output curb of around 500,000 barrels per day it wanted to stick to previously. So what we can see here is, yes, overall the price of WTI coming off, but short term it's trying to hold on that news out of Russia. Having said all that, the latest EIA report also showed that US inventories rose by 7.65 million barrels to 850.6 million in the week ending the 17th of February. That was the highest level seen since September of 2022, meaning that basically there is still a lot of oil around. I mean, the stockpiles in the US are very high, and that could lead to further downside being seen in the days ahead. Now, with regards to the technical picture here, as we can see, the 3-week downtrend line here currently caps any further upside with regards to WTI, and that comes in around the $77.12 mark. And basically, as long as we stay below there, and the sort of high we saw on the 3rd of February around $78.16, for me, technically speaking, the odds are still stacked towards further downside being seen. So if we were to fall to $73.85, and also the December to February uptrend line, which currently comes in around $73.40, then I think we would not only see a retest of the January and February lows between $72.64 and $70.50, but also a slip back down towards the December low at $70.25 being likely. So technically speaking, for me, yes, we're still trading in a sideways trading range since mid-November, but the bias is pointing towards lower oil prices in the days and weeks ahead. And that could also be on the back of a stronger US dollar, because as you can see here with regards to gold, we have been coming off on the back of that US stronger dollar. And here also we have a very strong correlation, a negative correlation between the price of the US dollar and the price of gold. So when the US dollar goes up, gold goes down. As you can see here, gold hit our target area, which we mentioned over the last couple of weeks, between $1,824 and $1,810 per troy ounce, but today tested the low end of that support area. And if we were to close below $1,810 on a daily closing basis, I believe that we would then be heading back down again towards the mid-November high, $1,787, and also the red line here, which is the 200-day simple moving average at $1,776. And the only reason for me to not expect this to happen would be if we were to see a bullish reversal take us back up again above the 20th and the 22nd of February highs between $1,846 and $47. So as long as we stay below $1,847, I think further downside is actually in store with regards to the price of gold. Now, today I'd like to finish up on a quick look at copper, which we also looked at last week. And last week, if you remember, I did say that the odds were pretty high of us coming back down again and retesting this November to February uptrend line and perhaps sliding through it. And this is actually what happened last Friday. And the fact that we had this fast decline. And basically, if you also look at the candles, can you see that the last 3 negative candles we saw last week basically took out all these positive candles, and we're talking about, I don't know, 8 or 9 or 10 candles going all the way back to the 6th of February. And when that happens, when 1 or 2 candles take out all the previous development in the opposite direction of a chart, that is actually telling you that the momentum has shifted, and in this case it's shifted to the downside. And as you can see here, we have held so far above key support, and which is made up between $8,629, $8,593 per ton between the November and December highs. So we've held above there for the time being, and are currently retesting our breached uptrend line, which now, because of inverse polarity, acts as a resistance line, which is totally normal. But what then often happens is that leads to another move to the downside, mirroring the previous move to the downside we've seen. And that would then probably take us through the support area, back down again towards the 200-day simple moving average at $8,302, and perhaps also towards the January low at $8,189. So for me, technically speaking, as long as we stay below the last reaction high, that is to say last week's high at $9,212, if that doesn't get taken out to the upside, further downside is in place for me, and I believe that we can then head back down again towards the 200-day simple moving average at $8,302. Thank you very much for watching Charting the Markets with me, Axel Rudolph. Please feel free to follow me on Twitter. My Twitter handle is @AxelR_IG.